Hello and welcome to the AEG Insights webinar series. This is Accelerate Value Growth with Advanced Analytics. And this program presentation is one of a series of webinars sponsored by the Association for Enterprise Growth. Webinars further AEG's mission to help C-level executives, owners, and boards of small to mid-sized companies strengthen their operations, grow enterprise value, and maximize their personal wealth. AEG is a tightly knit ecosystem of about 40 experts, business professionals, and complementary disciplines drawn from some of the top firms in the Washington, D.C. region. We provide integrated, cost-effective expert and guidance to help owners of mid-market companies. We deal with complex business problems by working across disciplines to integrate the owner's personal and business needs and support them on the path to transition at the time and terms of their choosing. These webinars monthly and their professionals who deliver them are valued members of their individual disciplines, their companies, and the AEG ecosystem as a whole. Prior webinars of the past few months have addressed marketing, finding hidden cash flow, and employee benefits. The common theme of these is all about directly strengthening operations and profitability and growing enterprise value. This webinar will be a half an hour. There will be time for questions at the end. Everyone is muted at this time, and we will proceed with the webinar now. We all think that running a business couldn't be simpler. All you actually need is a rotary telephone, an adding machine, a stapler, and a pencil cup with one pencil in it. However, and if you look at the graph on the right, profits seem to be doing just great. However, that's not exactly how things work. So to the average business owner or CEO or executive in any role, it's a little more complex than it looks. Changes in technology, demographics, economies, globalization, business practices, all of these things have made life a lot more complicated than they used to be. Now, you might think things have always been complicated, but business owners don't think that way. In 2010, IBM does their global CEO survey, and the results have been fairly consistent since then, that 83% of CEOs across the globe in every industry and every company size say complexity is their biggest daunting challenge. And only about half think they have a plan to deal with it. The rest are really just that they don't know how it's going to work. So if you're familiar with the term VUCA, the acronym stands for volatile, uncertain, complex, and ambiguous. That's the nature of what businesses are facing today. It doesn't matter how big or small, the amount of complexity in the environment affects every one of them. And the result of that is that the average companies are operating at a lower and lower level of performance because they're not dealing with or not even aware of the kinds of implications of this complexity. So it's kind of like driving your V8 car with 2 spark plugs missing. It'll get you around, but it's not very good for the company. It's not very good for the car, and it doesn't bode well for your ability to serve your customers or sell the company eventually. So the reason do we really care about this? Well, for a business owner, they care a lot because you can have companies, $25 million companies, a couple $1 million of EBITDA or profit. They all look the same from more or less than others. Even if you don't know the analytics of this, it does make it harder to attract customers, your talent, go to a bank and get capital or business partners. And the result of this is that about 2/3 of companies are really going to never sell, or they're going to fail shortly thereafter because they're not well structured. And given that half of the businesses, mid-market businesses, are owned by baby boomers, those are all transitioning now, and that's an important issue for the economy. If you're an advisor, it's an important issue for your clients, and if you're a business owner, it's an important issue for you. So if you think about your business as an engine, where revenues and profits are the output of the engine, the inside, the gears of those engines are all those factors that make it go. They all have to work together, just like in your car. They all have to work together. So some research was done about 12 years ago by a company that looked into all the private sector transactions across industries, across the geography of the US, and said, what are the things that actually drive value? What is it that makes a company worth 4x versus 6.5x? And they chewed through all these private sector transactions, tens of thousands of transactions, correcting for bubbles and outliers, and came up with 18 factors that make a difference between a valuable, highly operational, effective company and one that is dragging along. There are 9 of these in the market area and 9 in the operations. None of these should be a surprise to you. Now, the implications and the effectiveness of each one of these, the importance differs by industry and by location. So barriers to entry might be a big deal in the IT space, but it's not in the shipping space. Customer satisfaction may or may not be more important for a service company versus a manufacturing company. Each one of these factors has an important role to play in optimizing the value and effectiveness of your company. So the question is, so who says so? You know, what's to make you believe that this research is important? Well, the research was started at MIT by a guy named Chuck Richards, who couldn't figure out why the companies in his town when he grew up in, when he left for college, it was the wealthiest town in the state, and when he came back, it was one of the poorest. What was it that made a difference? So this is a personal mission for him. Developed this software at MIT, has been validated in a number of different areas. It is used by the US Department of Commerce and their manufacturing extension partnership. This is like the agricultural extension service that supports manufacturing companies developing best practices. The approach has been endorsed by NACFA. It's the professional association that certifies the people who actually do the hardcore valuations of business for when they sell or for tax reasons or divorce, whatever you need a valuation. It's also endorsed by the American City Business Journals. We've got 14 million CEO, C-level readers across the country. So it's also the point that this is a patented approach to development of enterprise value. This is not about the software, it's about the approach and the focus on the analytics. So the question is, how do I make sense of all this data? What do I do with it? It's great to have lots of data, but if I can't interpret it and turn that into something actionable, it doesn't really help. So we think about, Moneyball. If you remember the movie from a few years ago, it's not the highest paid players or the ones that are most popular. It's the blocking and tackling, not to mix metaphors, of the individual components of the team that actually make the company go, or in this case, the Oakland A's, to be a more effective team. So doing the assessment within 10 minutes, you can get a handle on what the value of your company is, how much value you're losing in each one of those 18 drivers, and where exactly you need to strengthen the organization. If you're driving a car and it's not running well, putting more gas in it or stepping on the gas pedal is not going to solve that problem. You really need to go to your gas station, plug it into the port on the computer, and find out what exactly is wrong with this. So if you think about this assessment, it doesn't require a lot of details on I need financial data. It's just a question is, what's the directional issue? And this is particularly useful when you get the C-level management team in the room to discuss this, because often they don't agree because they really don't have a good handle on exactly where the company is going on each one of these market and operational drivers. So if you look at the slide for the people on the phone, The issue is, you can say about branding. Our brand is everything. It's pretty strong. It's okay, or we don't have a brand. That the data behind this assessment will tell you what exactly the effect of having a weak brand in your particular geography and in your particular industry. So the result of this, again, after 10 minutes, is get a quick report. It's customized for you. It says, in this case, this is a company that has almost half of its value missing. It potentially could be worth almost $9 million. That gap could be almost $4 million. The question is, it'd be nice to know where that gap is if you did want to sell the company or partner or actually create a company that was attractive to employees. So having this information gives you some focus and guidance on where you are relative to others in the country. So this is about a little lower than halfway in performance of the company. But perhaps more important is to see how you are relative to your peers. So this company was in a technology company, and their sales and marketing was really, really poor. So the question is, gee, I didn't know that. I thought if I just got more customers or cut costs, I'd be in good shape. No, the loss of value of your company and the inefficiency is coming mostly from sales and marketing. But there are other areas in operations and finding a way to grow your market share. All those things are important. So rather than randomly pursuing a variety of growth strategies that you think should be pretty good, here's a way to find out exactly which ones are the problem. So it's a different company. It looks really good. They topped out on just about everything. It is run by, it's an engineering company. They are all about data. And so they're really working well on all the operational factors. However, they still have a gap of $7 million. And certainly in two of those areas, they have a big challenge. There's gaps in all areas, but customer satisfaction, not something to worry about. That deficit is down in the noise, at least this point. So what do you do about that? Well, here's a third company. You really have to dig deeper. You say, oh, well, this company has a $500,000 gap in sales and marketing. Well, what does that actually mean? This is where the conversation with an expert advisor and among the management team, now that you've got some focus, will help you say, well, gee, you know what? There are pieces of this. Is it a marketing data issue? Is it sales training? Is it a crummy product? Do I have legal issues? Is it market research? So this kind of assessment will give you some focus on what you need to address and what kind of skills you need to bring to bear on this particular problem. So it's not only that the diagnosis is important and teases out what's there and what's not there for you to address. It also provides an ability for you to actually go in and say, well, gee, what can I actually do about this? If I can address brand, that's important. If it's other issues about customer satisfaction or customer advantage, each one of those has a value that I can add to my company. Now, this is the assessment doesn't tell you what to do any more than your doctor's telling you have high cholesterol helps you. That data doesn't help you. But with some good advice and some work with the company, both internally and externally, you can figure out how to add this kind of value to the company. This is the company with a $7 million gap. Almost 10% of it is in each one of these areas. So the dynamite over on the right is an indication of how easy this is likely to be. You may want to go after the biggest value gaps first. You may want to go after them in areas where you have particular expertise or opportunities to improve, or you may want to go after the ones that are the easy wins, and that would be sort of the bang for the buck. So on the second column, you say, well, this should be easy. I can pick this one off much quicker than I can the other ones. So you might say, so does this really work? Hard to say. So there are a couple instances where this has actually been used. It's been used by over 10,000 companies nationally. But the uh, Domestic Markets Expansion Program, part of the Manufacturing Extension Partnership in Virginia, was concerned about a lot of the companies in Southern Virginia who were really being hammered by sequestration. There's the Norfolk uh, Naval Base and others down there, all the companies that are associated with it. When sequestration put a dent in the military budget, they were really hurting. So they wanted to find out how do they get around that and how do they grow despite having a terrible market. So they put about 42 companies into a program and ran through this assessment and addressed the issues that were focused on. They planned to add 300 and some jobs. So they added over 600. Um, they were going to grow by 64 million. They grew by 207 million. So it made a huge difference. A number of them exited the program. They felt they had achieved what they needed, and so they um, then the um, push this out of third year. 70% of the companies dropped out, but they still added almost the same amount of revenue and jobs, so forth. So the issue here is that it's a challenging issue, and it does require not just the assessment, but the skills of a number of different people to bring to bear. If I don't know about managerial finance or IT or cybersecurity or sales training, I need to bring in those people. So same thing for whether you're a company or an advisor. If you don't have those skills, look at those 18 drivers, find a way to develop the skills internally, find external advisors to help you out with those. It's really it's important. So AEG was created specifically to address this. The increase in specialization, just like in healthcare, has made it more and more difficult for a person as a healthcare consumer and a business as an advice consumer to know exactly where they have the best chances of growing their value. So to quickly recap, we can go through some questions here. The complexity is really the new driver. The VUCA is a challenge for every company and actually every advisor, whether you're a nonprofit or a for-profit. Most companies are operating well below their potential. It was indicated that it's the average company is operating at 73% of performance level, and that's a research-derived number. And about 70% of them are operating so inefficiently that they will never sell. They're not attractive to sell. It's hard for them to get capital, even though there's plenty of capital to offer. Banks just don't want to lend to a company that's not running on all cylinders. So, and they also looking for evidence-based growth strategies. If you can't point to them about where your strategy is actually going to add value, rather than saying we're going to try to get more customers or we're going to cut costs, it's going to be hard to attract people or capital. So the research shows that there are 18 gears that drive value. Just trying harder is not going to do it. So some kind of an assessment, sort of a Moneyball approach, can actually provide some high ROI growth opportunities, can point out the value gaps, and ultimately having a multidisciplinary strategy is going to be what's going to grow value. So if we have any questions, we can I can answer those questions now. Let me just unmute everybody. So are there questions?
Hey, Mark, it's Chris. Can you show an example of the type of questions and inputs that produce the results that were shown in the dashboard?
I had this is one of the questions. Like I said, they're not highly detailed questions. You don't need to bring your financials to the room. The nature of this assessment can go into three different levels. The first one is a quick 10-minute assessment, and I'll give you the link to that. You can all take this assessment and experience it firsthand and get an individualized report on your company. So the questions are all are high level for this first assessment, the 10-minute assessment. It's quick and gives you a modest resolution. If you look on the next one, it says, yeah, the value gap on the top right is a range because there are only 18 questions, one per driver. But on the second level assessment, there are 78 additional questions. Each value driver has
Lost your sound.
So I'm going to let you unmute yourself if you need to chat here. So the value gap is a little bit is a range, and on the second assessment with more questions and it goes into more detail, 3 to 5 questions on each value driver. It is useful to have the entire management team there because there is a lot of discussion, even on a question as simple as this. What does it actually mean? What do you mean if you're the production head or the R&D head or the salesperson? What does it mean to say your brand is solid? This kind of structured conversation is incredibly useful. It's either a cathartic or an epiphany, catharsis and epiphany when teams go through this, but you get a much more detailed assessment. The value, again, it's not about the software, it's not about the assessment, it's about the way to have a conversation around each of these areas and get a sense of, gee, I'm focusing on entirely the wrong area. This is what I need to grow, and this is what I need to prove to either a bank or attracting talent for your management team or staff that the company is actually moving in a good direction. Like I said, this applies just as much to nonprofits as for-profits. Just because you're not issuing dividends or offering stock doesn't mean that you have the same, you shouldn't have the same operational effectiveness.
Mark, this is Norm. You said it applies just as much to nonprofits, which was a question I was about to ask, but it looked like a lot of the categories, a lot of the 18 items wouldn't necessarily apply to a nonprofit.
It's a great question, and a lot of nonprofits use this and they go, it doesn't apply to me. And said, you don't think that market share, wouldn't you like to provide your services to a larger area? Do you don't think brand is important? That people trust you, that you provide services, that's part of your brand. Margin, yes, you would like to have, you're not supposed to be making a profit, but you would like to at least generate enough revenue and margin to provide additional services. How you dispense with that relative to the IRA's tax status is up to you. But I don't think any company, any nonprofit would rather be not making money or not growing. Does that answer your question?
Yeah, I guess I didn't remember all of the 18. It just seemed like there were a few that didn't apply, but obviously the ones you mentioned do.
Right. So, and whether it's innovation or management or human resources, operations, product differentiation, all those kinds of things are important to every company. Just because the IRS has designated a certain tax status doesn't mean you're not an operating company.
That's true. Thank you.
Hey, Mark, this is Francie.
Hi, Francie.
Thank you for this. I can see a lot of utility for this and reasons to refer clients to you. I have a question though. Given your brain and your experience, have you thought at all about, or do you even think it's necessary to modify all of the points that you're making to serve the needs of, for example, IMC members, small businesses, not as Ernst & Young defines it, but as IMC defines it?
So IMC is Institute of Management Consultants. It's a professional association for independent management consultants, whether they be located in a global firm or solo practitioner. So the clients, just because the average client for the average company that's assessed by these is about $10 million. They range from $1 billion down to about $1 or $2 million. So it's been validated and built on those small companies. Now the assessment itself, there's the ability, again, not about the software, but the ability to change the language and address those. The coefficients and the drivers are going to be the same, but they could be described in a different way. It's really about the management team and any external advisors working through these issues and using this as a tool. The value in this is the multidisciplinary recognition that things are complex, and it's brand may be made up of several different aspects. Just like I gave the example of sales, it may be training, it may be data, it may be legal, et cetera. So you need a multidisciplinary team to come in. Just like in healthcare, my back hurt. Well, this could be 3 different things, not one thing. Did that answer the question?
Yeah, I think what you're saying is it's this level of analysis, or this the criteria of this analysis obviously aren't designed for companies considerably smaller than 10 million, but it still seems a worthwhile exercise to go through either this or some permutation of it for little businesses. I was just curious if you thought the modifications would have to be in terms of the questions themselves.
I don't think so. It's been validated down to a little over $1 million company.
Okay, gotcha. Okay.
It's the nature of the business. When you're down in the $500,000 company, the nature of the business is there isn't an HR department, et cetera. So there is some focus. And I think that's behooves the business owner and any advisors to recognize this. This is just a roadmap. It points you in the right direction and tells you how high the mountain is. It's still up to you to make the decisions about how you actually want to transit that.
Thank you.
Any other questions about the source of the data or the actual implementation?
So if I were to recommend this to a client that's 10 million or over, and would I set, I mean, obviously I couldn't give a lot of detail, but would they expect a team of people from AEG to come out and talk to them, or what is their first step after the call? How does AEC launch the consultation?
Well, just have one person. It's just a discovery call, like every other consultation is to say, what is the issue? What are your aspirations? Where are you going to play? How do you think you're going to win economically? What kind of capabilities do you need? Sort of a overall strategy. And also the personal side. What are your personal goals? Have you tied your personal to your business goals? How are those work? Are you planning on selling, giving it to your children? What's the transition plan? And that's why the AEG focuses on business, personal, and monetization or transition of the business. Now, again, monetization is not an issue for the business, but it's certainly useful to look at for every organization, because the people in the organization actually do have personal concerns that are tied to the business, even if they're not the owners. But we go out, have that initial conversation, get a sense of what's actually needed, just like you would go to your general practitioner or your primary care physician, and she would look at you and say, you know what, I think you ought to see these two specialists. That's the way we would go.
I gotcha. Okay.
Only if needed. If you like your health plan, you can keep it. And if it says you've got a $2 million gap in sales and marketing, and you say, I have a sales and marketing person, we would say, okay, that's fine. You ought to go talk to your sales and marketing person about why there's a $2 million gap. We can help or not. We're not trying to proselytize or push here. We're pointing out the fact that we have the capabilities. The people we have in AEG, have taken companies from 2 to 10 to 50 to $100 million. We're not so interested in a $200 million or $500 million company, but we do provide services to them.
Gotcha. Okay. Thank you.
So to do this on your own, to get a sense of what it is, you can use this for a client if you're an advisor, or you can do this for your own company. Use this URL. Make sure the bit.ly has a period in the middle of it. bit.ly/AEG 2018-10. And that will take you to the core value website. Once you submit your data, you'll immediately be emailed a report, and you'll get a sense of where your company's deficits and growth opportunities are.
This is really interesting, Mark. Thank you.
And I think that the most interesting part of this, and I appreciate the comment, is the aha you say from the company. They say, it never occurred to me that this was an issue, or holy smokes, I can't believe we're missing half of our value. And certainly for companies that are thinking of exiting, and if they don't have their personal plan and their business plan tied together, and they're running at a 50% deficit, and they think they're going to sell in competition to somebody else who's really spiffed it up, think about selling your house. You have somebody come in, you have a housing inspector come in and make sure everything's working well. You stage the house. And once you've done that, you go, why am I moving? This is really a great place to live, just like your company. Once this is really rocking and rolling and everything's working well, it's great for the employees. It's great for your banker. It's great for your shareholders if you have them. It makes a huge difference in how the company is run and your life as an owner or a manager of the company. So we've reached the end of our time here. I'd like to thank you all for participating. This Accelerate Value Growth with Advanced Analytics. And we're going to have more webinars next month. Will be the 5 principles of business transformation.